Good morning, hello and welcome to Opening Bell. You're with us on Money Control. I'm Surabhi Upadhyay. It's a Thursday morning and we're digesting the results from the FOMC meeting where interest rates were left unchanged exactly as was anticipated. However, once again, there's a massive move in precious metals. Oil is also on the boil. And the question for us here in India is, can the bulls continue to strengthen their grip on the market? The bulls made a second-day recovery yesterday. They've taken out some technical levels, but again, the texture of the market has been very, very vulnerable over the last several weeks. So is that set to change? Should you be buying at the start of trade today? What are the stocks to watch? Well, we have you completely covered over the next hour and a half. Let's start with the headlines. The U.S. Federal Reserve leaves interest rates unchanged in line with expectations. Fed Chair Jerome Powell has raised the economic growth forecast but said that the labor market remains challenging. The S&P 500 touched the 7,000 mark for the first time ever before paring gains. Investors also digest earnings from Meta and Tesla. Markets across the Asia-Pacific region trade mixed after the U.S. Federal Reserve's rate decision. The GIFT Nifty is indicating a slightly weaker start for Indian equities. Crude oil prices have climbed to their highest level in 4 months as geopolitical risk premiums rise following renewed U.S. threats against Iran. Gold has surged more than 3% to a fresh record high. It has crossed the $5,500 an ounce mark in the international markets after the Fed decision. Infrastructure major L&T has reported a 10% increase in revenue along with record quarterly order inflows of 1.35 lakh crore rupees. However, profits were impacted after the new labor code, resulting in a 1,300 crore rupee hit. Meanwhile, key earnings to watch today include Tata Motors and ITC. The government is all set to table the economic survey for 2026-27 in the parliament today. The annual report reviews trends and performance over the past year and lays out the top priorities for the government for the year ahead. And the union budget, of course, is on Sunday. All right, those are the big headlines. And remember, on the show today, we're also going to be talking about something very, very interesting. Money Control here has kick-started. It's Eco Pulse. It's an economic indicator that combines 33 different high-frequency indicators, and you get real-time access to economic information. More on that as we go along on the show as well. But for the time being, let's get started by diving a little deeper into these, global cues and trading cues that we have. Let's start with the global picture. U.S. markets, pretty interesting headlines coming there, as you just heard. 7,000 on the S&P 500, but then the market cooled off a little bit. The first, of course, big thing to note is that the Federal Reserve has left interest rates unchanged. The FOMC statement indicated that economic activity has been expanding at a quote-unquote solid pace. So that is what the statement said. It used the word solid. And because of this, we saw a bit of an inch up in bond yields as well. The statement went on to say that unemployment rate has shown some signs of stabilization. So the Fed, at least for the time being, doesn't seem too perturbed about the labor market or about growth. Now, as all this was happening, gold was the other big headline. Once again, we've had a 3% surge in overnight price action. Gold actually crossed 5,500 USD. This is spot gold prices, and then it cooled off a little bit, but largely speaking, the bets are still positive across the Asian region. Silver wasn't too far behind. Silver managed to put on about 4.5% as well. So the rise in precious metals continues. Now, as I was saying, that after the FOMC statement, given that the Federal Reserve isn't sounding too cautious on the U.S. economy right now, Treasury yields inched up a little bit. The U.S. 10-year yield, for instance, is now closer to the 4.24% handle. Another important and interesting development, U.S. Treasury Secretary Scott Bessent denied any plans of U.S. intervening in the global currency markets because there was a lot of chatter about whether the U.S. and Japan will do some sort of coordinated action to, take charge of what's happening with the dollar-yen, with the dollar tumbling and the yen surging. Scott Bessent says nothing of the sort is happening. But that, again, didn't, I mean, it helped the dollar to an extent, but overall the dollar continues to struggle. The dollar index is still around the 96% handle, and because of the weakness in the dollar, we've seen this unrelenting rise in precious metals even overnight. Now that's on the the market side. Let's talk about corporate earnings. Plenty of action there as well, and interesting moves in after hours trading action. Meta shares are up 7%. Numbers are better than expected, and the guidance for the first quarter of the calendar year is also stronger than what the market had in mind. So Meta stock is in focus. On the flip side, Microsoft didn't have such a great quarter. Earnings were lower. Their cloud business didn't grow as well as people were expecting it to, and shares were down about 6%. Tesla results were above expectations. The stock was up 1% in US trade. Now that's the global backdrop, and like we told you, Asian markets are also largely mixed. Let's look at some of the domestic cues. The first good cue coming in is on the macros. December IIP numbers are looking very, very good. In fact, December IIP is now at a 26-month high. It's come in at 7.6%. And this is the second consecutive month that we are seeing gains in excess of 7% come in on IIP. We've seen a couple of components like mining and electricity. They've continued to charge ahead. Manufacturing, month on month is slightly weak, but all in all, it's not a bad number on IIP at all. Now let's come to the trading cues here. Now, the market continued to try and claw its way back yesterday, and it was very heartening to see the pullback in mid caps. So the headline index, of course, the Nifty managed to climb higher, but mid caps is where the action was. The market breadth was also quite positive, and the other good thing was that the VIX, the volatility index, fell about 6.5%. So that sense of fear in the market is receding. Usually gives us an indication that maybe sentiment is gradually turning, but we'll talk more about this with our technical experts. Finally, let me wrap it up with the fund flow picture. FIIs yesterday, guess what? They did not sell cash equities yesterday. Surprise, surprise, they were actually net buyers in the market, and this is not something that we see too often these days. So that was a very good cue. Domestic institutions were also on the buy side. They bought cash stocks worth about 3,360 crore rupees. So that's how trade is playing up. Now, before we go on, we were talking about the big announcement from the Federal Reserve, and I want to highlight that beyond the policy where the interest rates were left unchanged, the most interesting part of that press conference was reporters trying to ask Fed Chief Powell what he thinks of all the pressure that he's getting from Donald Trump and what he thinks about the Fed's independence. Take a look at what Jerome Powell said.
While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. If people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Okay, so there you see sparks flying in the press conference as well. His advice to the next Fed chief who comes in the middle of this year around summer. Pretty interesting statements coming in over there. But for the time being, let's move on and welcome in our guests on the show. We have Jatin Geria, Vice President Technical Research at Teji Mandi, joining in. We also have Deven Choksi, Director at DR Choksi FinServe. Thank you so much, gentlemen, for being with us. Deven, welcome to you. First time that we're talking on money control. Jatin, of course, was there earlier on the show as well. But good to have both of you gentlemen joining in. And morning to both.
Thank you, Surbhi, for having me on the show.
Well, Deven, let me open with you and talk about, what you think in terms of the texture of the market, just in terms of sentiment and what you're seeing in terms of corporate earnings. It's been a really brutal January, but last 2 days, at least the fall has kind of, paused. Do you get the sense that earnings and overall the way we're seeing, global markets shape up, is it giving bulls some kind of a breathing headroom now?
Yes, Surbhi, good morning once again. Well, I believe that I think overall the fabric is, I think, quite strong as far as India corporate earning outlook is concerned. third quarter has been better compared to the second quarter, save and except the labor code impact, I think, which has come in some of the companies. But otherwise, on the whole, the top line and the EBITDA margin performance, I think, for most of the companies in general, has been extremely, I think, convincing. And that is not very surprising though, because I think the cost structure is, I think, remaining under control. In my viewpoint, I think we continue with this trend as far as the corporate earning outlook is concerned. And very surprisingly, the global currency outlook, I think, is giving a proper cue to India that the currency should not fall, but at the same time, I think we are having a depreciated rupee at this point of time, which to me, I think, is more technical in nature than otherwise. The dollar has actually, I think, fallen. And in my viewpoint, I think the Indian rupee deserves to remain a little more stable now than before. And that's what an early indication in the market is now showing. Maybe some amount of buying is returning back into the market. Given the kind of valuation at which I think most of the stocks are quoting today, particularly the frontline stocks, the index stocks, in my viewpoint, I think it would be extremely appropriate to think that some of the global players, I think, would start buying again into the Indian market at current levels. So one would remain cautiously optimistic about the possibilities going forward.
Okay, cautiously optimistic. I guess that's the way to be, right? Perhaps it's almost a rule for life to always be cautiously optimistic. Devin, hang on. So let's put the technical snapshot on this as well. Jatin, morning to you. 2 days, some sign of relief. At least we're back to about 25,300. But is it looking convincing?
Yeah, good morning, everyone. So yes, on the hourly charts, what we observe is that the lower top, lower bottom formation has been negated. So that is a sign of a trend reversal after around 5% cut on the Nifty. So that are the first signs of a trend reversal that we are seeing on the hourly charts. We believe that today we might just see a subdued opening. However, I would be a buyer in this weakness. I would place a stop loss around 25,180 on the downside and go long on the Nifty. We are expecting around 25,500 on the upside. See, there are a couple of factors that are helping my view. One is the price formation on the hourly charts. Apart from that, the FI buying in yesterday's trading session, the India VIX cooling off, all these factors, help the Nifty to, stabilize and attract some buying interest at lower levels. So I believe that today's morning weakness should be considered as a buying opportunity. And yes, we are expecting 25,500 on the upside.
25,500 on the upside. Very interesting. Jatin, so your long call is only for the Nifty, or do you think even the Bank Nifty can be traded on the long side?
Yeah, see, I believe that the Bank Nifty also has some room on the upside. The PSU banks were, showing some amount of strength. However, considering that their weightage in the overall Bank Nifty is little less, so even that, considering that, we believe that Bank Nifty still has room for about 60,000 on the upside. So we believe that today's morning weakness should be considered as a buying opportunity. 59,200 is the level or the support that one should keep in mind. Below 59,200, I think the trend again turns little sideways. So one should keep a stop loss at 59,200 and go long in this weakness for about 60,000 on the upside.
Okay, all right. So that's a positive view coming in on technicals, and Jatin is talking about a positive trade. Now there are lots of numbers to discuss with both our guests, and Devin, I want to start with L&T. Just allow me to quickly run through the headlines. Basically, this is some of the major earnings, some of the index heavyweights. So here we go. These are our stocks and news for the morning. Starting with L&T. The profit is a bit of a disappointment. The profit is down about 4.3%, but you can blame that on that labor code impact, higher wage costs, that kind of ate into the bottom line. Revenue growth is 10.5%. The order inflows for L&T look very, very good. The margin has come in at 10.4% versus 9.67%. So margins and core margins are looking good for L&T. The company, in its conversation to CNBC TV 18, mentioned that revenue growth guidance is maintained at 15%. And L&T is saying that it will exceed its order inflow guidance of 10% in this year. It's maintaining its core margin guidance at 8.5%. So overall, the commentary and the internals look very good. Let's quickly move on. M&M Financial, profit is down about 10%. The net interest income growth is, however, looking pretty decent at about 20.6%. So watch those headline numbers. SBI Card, the profit has actually done very well. Year on year, the profit growth is about 45%. The revenue growth is at about 11%. Now for NSDL, profit is up about 4.5%. The revenue is very flat for NSDL. It's just about a 1%, less than 1% increase coming in. The margin for NSDL, however, has expanded quite handsomely. Margins for NSDL almost at 30% now versus 25%. This is at the EBITDA level. Mixed news coming in for the shipbuilders. Garden Reach has had a good quarter. They have met expectations on most parameters. Profits have jumped 74%, nearly 74%, and the revenue has really surged on stronger execution as well. A 49% jump in the top line for Garden Reach, and the margin is looking very, very handsome. 9% margin versus about 5.9% margin same time last year. Cochin Shipyard has not, however, had a good such a good quarter gone by. So the profit is down about 18% for Cochin Shipyard. The revenue growth is about 17.5%, and the margin has actually contracted quite a bit year on year, 13.8% versus 20.7%. Quickly rounding up Gland Pharma, numbers are looking steady. Profits up about 27%, revenue up about 22%. So those are some of the big ones, and let's actually talk about Star Health as well. Star Health has not had a very healthy quarter from the looks of it. The profit has declined quite significantly, 40% lower. The net earned premium, however, is up almost 12%. The underwriting losses for Star Health have increased quite substantially. Underwriting losses of almost 125 crores versus losses of about 48.9 crores last year. So those are some of the big numbers to watch out for. Let me quickly go to Deven on some of these. Deven, I want to start first with L&T. What did you make of the numbers, and what do you make of the valuations right now? So if someone is looking to add stocks to their medium-term portfolio, does L&T make the cut?
Yes, I think we look at the numbers. I think the order inflow in this quarter, I think probably is one of the highest. Even if you look at, I think the order inflow till date, I think execution available after more than almost 7.5 lakh crore kind of a order book pipeline, giving a phenomenal visibility. I think with around 30% year-on-year growth in this order book pipeline. In my viewpoint, I think this company deserves to be re-rated. Frankly, because I think they also been showing relatively better resistance to the cost right now, and I think the EBITDA margins are also improved in this quarter. I believe that I think the valuations are probably attractive enough, and another 20-25% kind of an upside in the stock price can't be ruled out, given the kind of strong tailwind in form of order book and the execution that they are demonstrating at this point of time. So one would remain fairly confident about the prospects going forward 12 months down the line. Yeah.
So L&T gets a thumbs up. What about some of the financial services numbers, Deven? SBI Card, how do you find it? Because there's so much talk about now the focus being on urban consumption and, spends going higher with all these GST and income tax cuts coming through. So what about SBI Cards? What about M&M Financial? How did you find those numbers in case you managed to take a look?
SBI Card in particular, I think more convincing, largely because of the fact that the higher amount of consumption related activity is reflected into the credit lending that the company has done. So from that perspective, I think you are seeing both the growth in the AUM side as well as the margin side. One looks at, I think, this particular number a little bit more positively and believe that even if it is one of kind of a quarter in which I think we have seen the maximum impact, more likelihood than not, I think they will continue to have reasonably higher growth in coming quarters as well. So I think would remain relatively more confident about the prospects going forward for SBI Cards at this point of time. Given the lower rate of interest and a lower provisioning outlook, probably I think this is one more point which should get added to the rationale for, I think, looking at this company more favorably.
Okay. Let me ask Jatin as well. Jatin, so we've had this whole bunch of numbers overnight, right? The bigger ones, say in L&T, Just technically, how does the stock look? And let me also talk about the shipbuilders, and I'll ask Devin separately on the fundamentals. But some of these defense stocks, they rallied big time yesterday, right? BEL, BEML, all of them were on fire. So give us some idea of if you see any interesting trades, either intraday or even positional. If someone wants to add these stocks to their portfolio, then from the defense pack, what looks good? And how do you rank a biggie like L&T?
Yeah, see, in the case of L&T, the stock has corrected more than 10% in the recent correction, and now it has reached its 200-day moving average, which is the long-term support. So, even if there is a reaction, we believe that that reaction might be bought into. So, we believe that on the upside, there is a scope for the stock to, rise towards 3950, even 4000 from a short-term perspective. So, keeping in mind, technically, it is extremely oversold, and we believe that there is a scope for the stock to, give a counter trend pullback over the next few trading sessions. So, I'll be a buyer in the case of L&T, and apart from that, the shipbuilders that you just mentioned, I believe that GE Shipping is one stock that we like in terms of price pattern. Is it has broken out of a triangle pattern on the upside, and we believe that it has been accompanied with a strong volume in yesterday's trading session. So multiple hurdles have been taken off, and we expect around 1250 to even 1275 in the case of GE Shipping. On the downside, the crucial support is placed at 1150. So that's a good risk reward to go long in the case of GE Shipping.
GE Shipping, nothing in defense, Jatin? I mean, there was this big, maybe it's just a pre-budget rally. Yeah, anything in defense?
So I believe that yesterday's move in most of the defense stocks was on the back of a positive announcement from BEL. So we believe that HAL is one counter where we can expect some amount of up move towards 4,800, 4,850. Considering it has been in a downtrend, or we can say a consolidation mode for more than 6 months now, and yesterday's price action was pretty decisive. So we expect the spillover to happen over the next few trading sessions. The risk reward is currently a little unfavorable considering it was up around 6.5% in yesterday's session. So I'll wait for a dip, and if I need to buy, then I'll buy some and keep some for a averaging out process in the case of a dip. On the upside, as I said, 4800, 4850 is a resistance, and on the downside, the support is placed around 4500.
Okay. Jatin, I'm going to come back to you for the final, your actual trades of the day, but allow me to just quickly go across and ask Devin what he thinks of defense and in general, any budget plays, Devin, so give us a take on defense, and some of the companies like Garden Reach came out with good numbers as well. But overall, from a budget perspective, be it defense, be it any other sector, would you look at adding any stocks to the portfolio? And again, this is not a short-term trade that I'm talking about, but where you really expect maybe electronics manufacturing, maybe something in renewables, where you think the government could be making favorable announcements and maybe there is a real fundamental case of having those stocks in the portfolio.
So I think, with the defense one, I think fortunately you have got good amount of visibility of order book and its execution, including Garden Reach. I think was squarely suggested, the management has suggested their focus is now shifting not onto the execution side of the activity. However, and I think they are basically, going to be seeing a more profitable quarters going forward as well. But in my viewpoint, I think everything is in price today. Today's market is not going to give the premium valuation to companies which it has given in the previous years. I think the valuation rationalization is a demand this market is going to be making from one and every other company. Having said that, I think the government's approach on defense is going to be extraordinarily strong as far as budgetary allocation is concerned. And that's where probably I think most of the companies are likely to be, seeing the benefits coming into their execution as well as in their books for the orders. In my viewpoint, I think one should not be in a hurry to buy in any of these stocks, adequately priced in my viewpoint. Though even BL kind of companies also have given a good result. and I think showing a good visibility of order book, but at the same time, everything is in price. So one should wait for the correction in the price to buy. That is what my viewpoint would be. It is better to play safe currently, even though the allocations are going to be on a higher side in the budget.
Okay, well, it's that time on the show when our guests give us their ideas. You know, the compounding idea, we'll get to Devin in just a bit, and the trades of the day, we will take with Jatin. So, Jatin, you go first. What are your trades of the day?
Yeah, so we have two trading recommendations. The first one is Power Finance Corporation. So in yesterday's trading session, it has surpassed a multiple hurdle zone of 375 to 378. That was the multiple hurdle zone. We believe that on the upside, there is a scope for the stock to move towards 400, 405 on the upside. So PFC is our first trading bet, 375 on the down should be kept as a stop loss, and 405 is the target area. Apart from that, the PSU banks are resuming their up move. So Bank of Baroda, which is expected to deliver its result in the tomorrow's trading session. So we believe that Bank of Baroda has a interesting setup, breaking out from a pole and flag pattern. So we believe that Bank of Baroda is a buy at current levels. On the upside, we are expecting 318, and we should keep a stop loss at 298 on the downside.
Okay, all right, got that. Jatin, thank you very much. You have a great session, good trading day ahead, and we look forward to connecting again soon. Thank you very much. Okay.
Thank you.
Devin, we've discussed a bunch of ideas, a bunch of stocks, but let me throw it open to you now. And this is that segment which we call the compounding idea. And as the name suggests, this is not a short-term trade, but anything that stood out, maybe from the earnings season so far, maybe budget, as you said, but maybe if you could name one or two stocks that that come to your mind.
Well, I think we find some of the auto ancillary business, I think, worth looking at again, I think, in the portfolio. Given the current stock price correction in companies like Minda and Minda Power, and given that their position is squarely with EV segment along with, I think, the ICE segment, in my viewpoint, I think these particular companies, they deserve to be looked into the portfolio with a very, very systematic approach for compounding. Also, because of the free trade agreement, I think there is a one distinct possibility which is opening up that European majors are likely to take position in India by systematically aligning with some of the ancillary companies. And that's where probably I find that I think these two companies with their advanced level of workout that they have done through their R&D space, including in infotainment and including in ADAS kind of a mechanism, I believe that I think these companies probably deserves to be seen, I think, differently from a long-term perspective as well.
Okay, that's a really interesting one. And Devin, just before we let you go, so overall on autos, this whole EU FTA caused fair amount of volatility. For first people got quite worried about stocks like M&M or even Tata Motors for that matter, fearing that all these cheap European cars will come in. But now it's very clear that there are thresholds in place and there are quotas in place. So, on the whole, if you're talking about OEM stocks, then what's your sense on something like M&M, which has been such a huge wealth creator already? Anything else in the passenger vehicle space that you'd buy?
So we continue to remain bullish about the prospects of Indian OEMs, and Mahindra and Mahindra, Tata passenger vehicle, as well as Maruti. All three of them in the listed space, I think they look absolutely convincing from investment perspective as well. In fact, I think the FTA is going to be more beneficiary to these companies because the kind of product that they are manufacturing at the price point, probably I think this is going to be creating a larger amount of presence for these companies into the European markets. So it's a long run game, it's not immediate. But in my viewpoint, I think these companies will remain in a higher export driven kind of business position. And that's where probably I think one should look at them a little bit more convincingly. Maybe current price regime of I think some of the stocks have already moved up. Correction in the stock price definitely I think is a welcome move when you want to add them into the portfolio. But we remain convinced about the prospects going forward for Indian OEMs.
Okay, all right, Devin, great conversation and very, very helpful. Thank you very much for joining us today. And we look forward to connecting with you more frequently and, relying on your wisdom to get through what has otherwise been a very, very difficult market last couple of months. Thank you for joining and have a great day.
You too. Thank you,
Thank you.
Samir.
Okay, all right. I just want to tell our viewers before we move on to our next segment that the pre-open session has kicked off and it's not too bad. The Nifty in pre-open is up about 30 to 35 odd points right now. And the stock to focus on would be L&T. Market is, taking those numbers with both hands. Numbers have been good. Performance seems to be good. Order inflow is, quite fine. And the company is sounding quite optimistic on margins. So that stock's up about 2 to 2.5%. More on the pre-open session in just a bit. But right now, it is time for the lead story. And what else can the lead story be at this time of the year but tax? Tax, and tax. Yes, you guessed it right. We are getting nicely warmed up to the big event on Sunday, which is the union budget. And to understand what kind of tax moves, at least on the direct tax front, if any at all, can we expect? We have with us Samir Gupta of EY, who heads the tax practice over there. Samir, thank you so much for joining in. I mean, I know it's pretty early morning, but I think everyone's now, awake pretty much 24/7 trying to figure out if the finance minister has any more goodies in her bag, or has she given the goodies away? GSTs happened, income taxes happened. So, ab kya bacha hai?
No, you're right. Nice to see you, Surbhi. And I have to get used to this early hour with your, new steer at Money Control. So thanks for having me. Look,
It's
you're right.
digital. Yes.
This is the way forward. Absolutely. No, I was saying that, look, I think a couple of things. One is, like you rightly said, both on the GST side as well as the direct tax side, corporate tax earlier and personal income tax last year. They have given a lot of, goodies already. We have a new Income Tax Act, which is now live from April 1, 2026. So the way I see this, Surbhi, is that they will just maintain the path where they're going to work on simplicity. And what I mean by that is the new Income Tax Act, as we know, has been framed where they have tried to do away with redundancies, they are trying to reduce litigation, and they're also trying to work in a way where that act itself is user-friendly. So I think staying with that same theme, 2 or 3 things I would still say. One, to ensure that, the direct tax collections also pick up. This year, while they had budgeted about 12%, they're still trailing at about 8%. So I do think that, they do need to work extensively on giving a lot of clarification circulars as we get into the transition into the new law. Because that is something which, at a fundamental level, whether the judicial interpretations of the 61 Act will equally apply in the 25 Act. Otherwise, you'll have a whole plethora of litigation starting with everybody interpreting the law all over again. So I think that's something which, needs to come in. And there are some anomalies, in the new act itself, which also need to be set right. And we've spoken about this, for example, demergers, fast track demergers. Okay. Demerger is a tax neutral concept. We all understand that. And it is so, even in the new Income Tax Act. But there is a concept of fast track demergers, where basically if you go to the ROC and you get a demerger done as against the NCLT, and these are for, intra-group companies, small companies, that somehow seems to have not been covered from a tax neutrality point of view. So that needs to come in. There are some provisions around carry forward of loss for closely held companies where the ownership changes by more than 51%. There are some language issues that will make this difficult. If a company lost 51% and after 2-3 years again came back to the same shareholders who now hold 51%. So I think some of these things from a simplicity point of view, I think definitely need to be taken care of. I'll just pause there and then, take any more questions you have. And
but Samir, Samir, the thing is that I'm all for tax simplicity. We need clarification. We need lesser litigation. But from our viewers' perspective, the thing they're most interested in is the rate or the rates, right? Yes. So let me ask you about that. I mean, on the rates, now considering we had this big change in capital gains tax just last year, right? 10% became 12.5%. Some are arguing the market is so underwhelming, and then, is there a case for a rollback, partial rollback, some carve out, increase the threshold because there is no gain. So what are you taxing? That's the market argument. But let me ask you, let me go one by one on the big taxes and see if you think that there is a case to change anything. So let's start with capital gains. Anything there?
So capital gains, I think, see, one of the asks on capital gains has been that LTCG, like you rightly said, has gone from 0 to 10 to 12.5, correct? And when it was 0, they introduced STT. So the question that, is there on everyone's mind is that they've continued with the STT levy, even while the LTCG has gone from 0 to 12.5. So is there a way in which, one can balance taxation by at least going with only one of the two? And that is something which I think is paramount in people's mind. The flip side is that the budget for STT collection this year was as high as 80,000 crores. So there's a lot of money on the table for the government. So that is one issue which I think does stack up. From my FPI point of view, and we've discussed this, when they invest globally, they, rarely pay capital gains tax because, they are investing only on the market, and portfolio gains in most countries is exempt from capital gains tax. So the question is, that they are happy to pay STT, but they do not want the LTCG at least. So these are the asks really. Now, I'm not sure in this year, when collections are a little tepid, and with next year coming up with all the volatility that's around, whether they will do something on the capital gains tax rate.
Okay, so maybe we don't see too much on capital gains. On either the rate of corporate tax, Samir, or income tax. Income tax, I don't even know how to ask you the question because it has been sweetened so, in such a big way last year, right? The new concessional tax regime. But still, I mean, for the few people who are there in the old regime, anything on income tax, anything on the rate of corporate tax, maybe for preferred sectors. The government always has these preferred sectors, right? Manufacturing, semiconductor, etc. Would you expect any tax sweeteners?
Yeah, so two things I would say should be over there. One is that, yes, somewhere, everybody in the global world is clear that the minimum tax at which every corporate must survive or pay tax is at 15%. And we are at, if you include surcharge and everything, at 25.17. That's the corporate tax rate for Indian companies. Yes, for giving impetus to data centers, AI, space technology, robotics, for all of these, there seems to be a case to have a concessional tax rate for new companies that get into this business, right? We've seen this earlier in the manufacturing space in 2019 when it was there. So that is one key area where, to bring investments in. You can bring policy changes and, give PLI, etc. But on the long-term profitability and, recouping the money that you're paying tax on, I think on that piece, concessional regime for these kind of sectors, like I just called out, I think that would be a welcome thing. And the other, of course, is foreign companies who are operating similarly in these areas, right? For them also, to keep it simple, you can have a presumptive rate of tax saying that, okay, if you are engaging in any of these areas like AI, space, robotics, data centers in India, and you're carrying out operations, then for anything that you're doing to help Indian companies set up data centers and you're providing technology to them, we will tax you at a presumptive rate. They started this with electronic manufacturing last year. I think that is a good way to also bring in, foreign players into India to actually make this thing work. So that's
Foreign
one thing which I would think also
players.
is a good thing. That's right. That's right. That's right. So there's a case for 15%
all right,
tax rate
Samir,
for all of
just
these
allow
sectors.
us.
Yeah.
For all the so-called sunrise sectors or the preferred sectors, strategic sectors for India, maybe do a concessional 15% rate for new manufacturing or new companies that are being set up in these sectors. Samir, allow us a couple of minutes. We've just hit market opening. We'll come back and complete the conversation. Let's take a look at what we have on the screen then. And the market, imagine, I mean, the pre-open was suggesting that we'll start a little positive, but that's not how it's playing out. Right now, we're dealing with about a 0.25% cut on the screen. The mid-cap index is very flat. The bank nifty is down about 0.3%. So it's not a big slide or anything, but it's a cautious start after 2 days of gains. Okay, let's come down to the big newsmakers and the big stocks right now. L&T, I can see on the screen 2.5% up. That is obviously being well rewarded for the numbers that have gone down well. Their order book has swollen up. Margins are looking good. and the company has reiterated its guidance as well. So L&T should come up on your screen. That stock is doing quite well. Hindalco is the other gainer. We're seeing some gains on ONGC as well. But on the flip side, now let's talk about some of the losers. Maruti is still under pressure. Maruti's numbers, of course, came out yesterday, not too enthusing. And then the worry is whether the best of this GST pop for automakers, which was driving sales last couple of months, whether that is over. 3.5% down on Maruti. Some of the other losers include Dr. Reddy's, SBI Life. Asian Paints is still reeling under pressure. Asian Paints was a big result casualty yesterday. And even this morning, it's down another percent and a half. Okay, let's start calling out some stocks which were in the news on the back of earnings. Let's take a look at what's happening with SBI Card. Let's take a look at what's happening with M&M Financial. We'll just get these stocks up for you on the screen. There is Garden Reach Shipbuilders and there is Cochin Shipyard. All these companies came out with numbers. Most are flat. SBI Card is down about 1%. M&M Finance is down about 2%. That's State Bank of India. We should pull up SBI Card. That's the one I'm talking about. 1% lower on that stock. Garden Reach Shipbuilders, good numbers coming in for Garden Reach, and that stock is up about 3% at this point. Cochin Shipyard didn't have such a hot quarter, and that stock is down about 0.25%. So those are some of the early movers and shakers. Let me see what else is moving in the mid-cap market. GE Vernova T&D came out with numbers. And the quarter has been looking good for GE Vernova. The stock's doing very well, 6-7% up on GE Vernova T&D this morning. Hindustan Copper, no ending. This whole sort of metals race that we've got going. Hind Copper is up about 7% this morning. These are some of the names that stand out. Hitachi Energy is up about 4%. So that's a stock that's looking good as well. Those are the major gainers on the upside. There you go, Hindustan Copper on your screens right now. I'm just looking at losers. Motilal Oswal Financial Services yesterday rallied pretty well after numbers. Today there's some profit taking on that stock. It's down about 2% as we speak. Symphony came out with numbers, the air cooler company, and just like the AC makers, it's been a really tough year, not just a quarter, but a year for most of these companies, air coolers and air conditioners. Symphony is down about 2.5% as well. So these are some of the early trends. The market right now is stabilized. The Nifty down about 0.25%. Ditto for the Bank Nifty as well. So those are the opening moves as they are playing out. But let's go back to complete our conversation with Samir Gupta of EY. We are talking taxes and figuring out if there are any major changes that can be expected from the budget. So Samir, final thoughts coming through then on the big headlines, right? And what people are really interested in from a market or investing perspective. Buyback tax, dividend, because a lot of these were changed in the last 2-3 budgets. So on these, would you expect any further tinkering, or is there any further clarification or any change required at all?
So buyback tax, definitely, I think, there is a fit case to, rejig that. As we know, buyback tax is entirely treated as dividends, the entire buyback proceeds. So, you get no deduction for any cost that you may have spent in acquiring the shares, which is basically saying that, the entire thing is always deemed to come from dividends. Fundamentally, buybacks can happen from profits. It can happen from share premium and fresh issue of shares. So to the extent that it is not coming from dividends itself, there is a fit case to say that, it should not apply in such a situation. So I would think that buyback tax is one which they definitely need to have a relook at. And that is something that must come together. On the dividend taxation side, there is a lot that's going on in that space. The rates and all have been changed now. So personally, I don't see that, there is too much tinkering that they will do on the dividend side. I think we also spoke, Surbi, on the IFSC exchanges, right? There itself also every year there is
GIFT
something
City,
on the
yes,
IFSC exchange,
yes.
on the GIFT City, right? So that's another piece which I think, they will again focus on. 2 points I would call out. One is that, when you trade on the GIFT exchange, which GIFT entities can do and foreign investors can also do, there is a requirement to ensure that the gains on that are always treated as capital gains. There is under the domestic law a deeming fiction that if you trade on the market, the characterization is capital gains. So I think that is not yet there in the GIFT provisions. So that is one thing which I think needs to come out. And the other is, GIFT is being promoted also as a holding company regime. So there itself, there are some provisions which I think will make them a tax neutral structure. That is where I think a lot of effort needs to go in. So these two callouts would be there on the GIFT exchange side.
Okay. Also on on the digital piece, India did away with the so-called equalization levy. When we were taxing
Right.
the giant digital companies earlier, and many of them are of course
Right.
US based companies. Do you expect any changes there whatsoever in terms of the way
Yeah,
we
that's a
tax
great,
digital
actually.
income of global MNCs?
No, I think that's a great question. Look, we had a 6% equalization levy, as they call it, which was on all the digital revenues which are made by without having a presence in India, right? I think that at the time when you started the negotiations with the US, correct, I think we kind of amended the law in that context to take it out completely, right? Now, some countries continued with that levy. India actually withdrew it. I think that, depending on how the trade deal goes, you may see some, action on that front. But I think they will probably wait out to see the finality of the current trade negotiation that is on. Because in the middle of that trade negotiation to bring what they call the digital services tax, the DST, the equalization levy, I think that may, kind of topple the apple cart a bit. But there is a case, and there are a lot of murmurings that this may actually come back in some form. So we'll have to wait to see on budget day whether this is something they are bold enough to bring back.
Okay, all right. So let's see. If some of these important aspects get covered in the budget, or if the finance minister shows us that her priorities for this year could be entirely different. We'll see. It's just what now? A couple of days left. Not even two days left, right? Today we're on Thursday, Friday, Saturday, Sunday. Samir, you know
Yes,
where you have to
absolutely.
be on Sunday morning as well. We're going to make you work on the weekend.
Absolutely. It's always a pleasure to be with you. So I look forward to that on Sunday morning.
Thank you so much, Samir. You have a great
Thank
day,
you.
and we'll connect on budget day now. Thank you for joining us today.
All right. Take care.
Thank you.
Bye.
All right. Well, that's a view from EY coming in on what kind of direct tax changes perhaps one can anticipate in the budget, or at least what are the areas which perhaps require a little more fine tuning. With that, it's time to get our attention back to the market. The market is ambling along. Not much has changed. That's how we've opened today. About a 0.25% decline. It's more individual stocks that are in focus. And L&T continues to be in leadership position. It's doing really well after its numbers. Almost 3% up on L&T. The other theme in the market, which is very active, is metals once again. I mean, that's the only theme that seems to be working so far in 2026. And today, if you look at some of these metal stocks, look at Hindalco, look at Tata Steel. We just called out Hindustan Copper earlier. It's entirely the metals pack, and it's the Nifty Metals Index, which is showing the brightest shade of green right now. Okay, so that's metals, but for the time being, it's time to actually head out to our next segment, and it's time to welcome in our market maker. And our market maker this morning is Rahul Singh, who's CIO Equities at Tata Asset Management. Rahul, what a pleasure to be interacting with you. It's been a while. And I've interacted with most of my guests on television airwaves for decades, but it's a digital era, so it's time to go digital. Thank you so much for being with us this morning on Money Control.
No, thank you for inviting me. It's a pleasant change. So all the best.
Thank you. Thank you so much, Rahul. So let's start by understanding just how you're thinking and how you're feeling about this market. From an investor perspective, it's been a tough 12 months. Investors have had to show a lot of patience. Gains have not come by. Most of their funds are either negative or, only mildly positive. And investors are asking, how long will this last? What's your sense?
Yeah, in a way, I mean, what we have seen from middle of 2024 to now is normalization of returns and earnings coming back in sync in a way, because what we saw between 21 to 24 was earnings grew 15-20%, but the markets gave much higher returns than that, especially in small and mid. And in middle of 2024, mid-cap index was, I think, trading at 80% premium to Nifty 50. And that premium has now come down to 50%. So I think there is a lot of normalization happening at various levels. There is a normalization happening in Nifty 50 itself, where the valuation was 22, 23 times. Now we are down to 20 times forward. Mid-cap premium, as I said, has normalized. Similarly, the thematic kind of euphoria which we saw in power, defense, manufacturing, capital goods, that has also waned and kind of has become more stock specific now. So all in all, I think we've gone through a very healthy and kind of a very disciplined normalization process. And this is what happened between November 21 to March 23, if you recollect. That we made a peak in November 21, and from there 18 months, Nifty didn't do anything, and market did not do anything, and the returns followed. So I think we are in somewhat of a similar kind of a period, because so to that extent history is rhyming. It may not repeat completely, because 23, 24 were very good years. But I think earnings are coming back. We are seeing macro is actually in 23, in 24, 25, I think macros were good, micros were not good. Now I think the micro is improving, which means that the earnings trajectory, the corporate earnings are improving. But the macro is where a little bit of uncertainty has crept in terms of the way INR has behaved, the fact that there's not much room for a fiscal deficit to improve from here. So I think at the margin, macro is not going to surprise us positively anymore, which was supporting the market, and it will have to be led by corporate earnings. And thankfully, that seems to be coming back if we go by the results so far this quarter in the commentary.
So Rahul, can you elaborate on that? Because it's all boiling down to earnings, right? We have to justify our current premium. And do you think we'll get back to that 15-16% earnings radar? And B, even if we do get back to it, will that be enough from a foreign investor perspective?
No, that's a $1 billion question, and you've hit the nail on its head. If you look at, again, going back to 2024, middle of 2024, our valuation premium to the MSCI emerging markets was about 80-85%, and that premium has now come down to 55% or so. And thanks to us underperforming China, Korea, Taiwan last year by almost 30% in USD terms. So a lot of normalization has happened. I think the issue with not really, I don't see this premium expanding from here, but we might hold here, which means that, what the other countries have benefited is through the AI theme, which is China, Korea, Taiwan specifically. And India has obviously not benefited. We don't have obvious beneficiaries of the AI theme from a earnings or from a valuation perspective. So to that extent, that is a missed opportunity, or that is something which has been lacking in the market. And but now, and also other thing which was lacking was growth. And Nifty earnings growth rate was just 4-5% FY25 and FY25, FY26 if you take the CAGR. And that is coming back to 15-16% kind of a number next year, led by banks, led by commodity that you were mentioning. I think some of the earnings for Nifty are actually linked to commodities, and also USD, INR. Weaker INR actually, ironically, helps Nifty earnings. So there is a lot of support to the Nifty earnings for next year. So earnings coming back means, and with our valuation normalizing versus the emerging markets, means that probably the first sign of that should be visible in terms of the selling intensity tapering off a little bit. Also, the way US is behaving and the USD is behaving means emerging markets should start getting more flows. It might initially go to the other emerging markets and not India initially, but at least the selling intensity should start tapering. That should be the first sign we should watch out for. again, these are very, very macro, macro flow parameters.
Yeah. No, I was saying, Rahul, so all put together, you're not sounding too negative to me. So are you saying that 26 could be a better year for equity returns?
Yes, we are not. Definitely, it should be a better year. And it will be led by Nifty and then subsequently by mid and small caps.
Okay.
So we should also be mentally prepared for that and not really expect the kind of returns we got in mid and small caps and thematics in 23, 24 to repeat anytime soon, because it's a stock specific market. You see that even in the same sector, there are companies which are doing well in terms of results and get benefiting from that from a stock price point of view, and there are companies which are not doing well and getting punished for that. So we are seeing very, very divergent trends even within the sector.
So what's the advice, Rahul? And I mean, from your standpoint, as the house view, which are the big sectors where you think this earnings recovery is going to be very clearly visible, durable recovery, and therefore perhaps that part of the market starts outperforming as we get on this track, recovery track?
Well, as I said, it's difficult to pick a sector right now. It's more about stocks. But if I were to pick a sector, obviously it is BFSI, where we see a normalized growth returning to 12 to 18% kind of EPS growth. Looks very likely even from the large private sector or large public sector banks next year. Credit growth is reviving. So that's clearly a stable, steady, 12 to 18% kind of growth returning back. We are seeing some potential for growth surprising on consumption, but again, stock specific basis. Cement could be a year. This could be a year when cement starts to do well. Obviously, commodities, and there is, as I said, there are companies in Nifty and in the indices which benefit from commodity prices, and we see that also as a sector which is as a segment which is likely to drive the earnings growth rate.
Okay. So those are some sectors to keep in mind. Rahul, the other debate constantly is on the lack of a tech angle here in the Indian market, right? And that's one reason why markets like South Korea did so well, or even China for that matter, or the broader ASEAN region. We don't have this AI theme or this AI trade. So to that extent, will India still be singled out? Or do you think at some point maybe we start showing good signs of adopting AI, and therefore should one be looking at Indian IT services companies?
Well, I think the Indian IT companies are making a valiant effort to make themselves relevant in the development side and application side, and also legacy modernization side. So I think there are green shoots visible as to how they could benefit from the AI theme. But at the same time, there are headwinds in terms of the productivity gains which they have to pass on. So right now, it's a tussle between macro not really picking up globally as much as they would wish to. Some headwinds in terms of the productivity gains which they have to pass on, and the new work which they are going to get from AI is kind of a tailwind. So I would say 2026 will go in this period of tussle. Maybe 2027 is when we will get a clearer picture of that. I think that's how I would look at it. So no, they are not currently being viewed as a clear beneficiaries of what AI could do to their revenue growth as of
the
now.
Whole AI move.
Yeah, as of now, there are early signs that it's becoming relevant, but whether to put it simply, whether the industry growth rate can go up from 3 to 5% to 10%, I think that is still some time away.
Okay, Rahul, final thoughts then to sum it all up. I go back to where I started, because it's been such a challenging year and investors realize that Indian equities aren't the only game in town. They're trying to, get onto the other playgrounds, whether it is silver, whether it's gold. People are now talking about whether they should be, dabbling in the copper market. So, and you yourself said that many of these metals, many of these commodities could be, of course, headed higher. But what's the advice to, end-level retail investors here who are investing in mutual funds? What would you say? I mean, even in terms of asset allocation, does it make sense to take higher exposure to these hard metals, to these precious metals at this point? Or should investors really keep the faith, largely with equities as 2026 rolls on?
So, Indian equities and gold, we are talking of two different drivers for this. Indian equities, I think I'm reasonably optimistic about this year as we just discussed. I think we buy gold for different reasons altogether. Because of the way there are global trends of moving away from dollar, of the de-dollarization. I think those things have picked up pace. We used to only discussed it theoretically 3 years back, but those things are becoming a reality. So to that extent, gold has to be part of the asset class. There are no two ways about it for the next 2 to 3 years. And it is you're buying a hedge, you're buying an insurance policy for something really going wrong globally in terms of the way the financial system works, or the way I think the markets are going to move away from dollars. Maybe it will not give you returns, but you still need to have it in the asset. I mean, that's the meaning of asset allocation, right? You're not expecting returns all the time, but you want to take cognizance of the risks which are there in the market, and therefore have gold and maybe silver in the portfolio. So one of the best ways for retail investors, we've always been saying for the last 1.5 years, is to buy, is to get into multi-asset funds, because we can have between 10-15% of gold and silver allocation. We can keep shuffling between the two depending on what we see as a relative risk reward. But it has to be part of the asset allocation. If you can do it yourself, fine. But otherwise, multi-asset funds and you look at the returns for multi-asset funds, risk adjusted, I think they have done quite well in the last 18 to 24 months.
Yeah. No, absolutely. And their exposure to precious metals has only helped compound those returns. Advice well taken, Rahul. Thank you very much for joining in. It's great to have that context in an otherwise slightly confusing marketplace. Thank you so much for being with us, and we look forward to more conversations on money control in the weeks and months ahead. Thank you.
Thank you very much. Thank you.
All right. Well, on that note, viewers, it's time for us to look back at the market. And the market screen has turned completely. By the way, pull up the Nifty once again. The Nifty is now down about 0.25%. Mid-cap index is flat. Bank Nifty is lower by about 0.25%. Nifty is down by about 0.5% actually right now. So the market has turned for the worse. And there is profit taking, plenty of profit taking. That is quite evident on the screen. BEL, Maruti, SBI Life, Interglobe Aviation. These are some of your Nifty losers. That's what I'm talking about. Suddenly we're at the lows of the morning. The Nifty has dipped. Let's see, 120 points down for now. Well, we're going to be talking macros and budget full throttle in just a minute. Before we get our next set of guests, do watch out for the biggest global headline. And those headlines came in from the Federal Reserve meeting, where the US Central Bank decided to leave interest rates unchanged. Hear out some of the statements from the FOMC, and we'll be back with our budget experts. Okay, welcome back to the program. And what we are talking about is the market getting a little jittery, about 100 points lower on the Nifty right now. And it's that time of the show where we turn our attention full throttle to the macros and to the budget, the big event that's lined up this weekend. Now, before we get to our experts on indirect taxation, here's something very, very special. Now you can go on to Money Control and at a glance, get a snapshot of 33 high-frequency indicators because Money Control has put together the Eco Pulse. And the wizard who's put all this data together for us is Ishan Gera, who's joining us now to explain how this Eco Pulse is going to work. Ishan, good morning.
Hi, good morning, Surabhi. As you were talking about in your previous segment about the uncertainty in the market and all, we are trying to bridge some of the uncertainty with regards to economy and macros in this. So what we have done is we've taken all these 33 indicators, as you mentioned, and combined them into one single number, which is the Money Control Eco Pulse Index. Now, the December reading of this number was 53.7, which was a slight pickup in momentum from the previous month. Now, readings above 50 indicate stronger than average economic conditions. Below 50 signal moderation, just like the PMI does. So it's easier for the people to read it. So that's our basic index for now. Back to you.
So, Ishan, explain to us how this is going to work. This is going to be a page that will be live on the Money Control website. And so you're saying that at a click, literally, one can look at any of these 33 indicators along with the overall index?
So, yeah, you can. So we have the overall index once you enter the page, which you can see on the screen right now. What you can do is you can compare it with the numbers also. Yes. For instance, you can see it with IIP here, which moved to a 26-month high yesterday, and that also influenced our index. So that is one part. So you can compare all the indicators with the larger index, and by clicking on one of the indicators, you can see how that indicator performs with other indices as well. The other aspect of it is the heat map, which you can again see on the screen right now in what is green and what's red. Red means they are moving down and green means it's moving up, very market language from that perspective. And that would also help people to understand which parts of the economy are moving ahead and which are not.
Very, very interesting, Ishan. This is going to make life a lot simpler for people who are trying to follow these indicators and these important, economic data points. Just very quickly, I know we can't run through all 33, but just give us some highlights. So you've taken IIP, I'm guessing you've taken inflation. Which are some of the major indicators that you're covering?
So for real-time economy, we are covering electricity demand, which shows you how industrial activity is doing. We are covering natural gas consumption, again, an indicator of industrial activity. We are tracking the infrastructure growth of the economy via the core sector. Inflation, as you said, is there, both retail and wholesale, so that you can check prices across. Also, what you have is some consumption side indicators. So UPI, you can check consumer durables, you can check four-wheeler sales, three-wheelers, which are very important data points from a market perspective also. And then you can check other data points like ATF consumption, air cargo, air passengers as well, and rail freight. So these are some of the indicators that we are tracking on this index.
Very, very interesting, Ishan. And the overall index, which is made of all these 33 indicators, when will that Money Control Economic Index be released every month?
So it will be released in the third week of every month, somewhere around 22nd and 23rd, once we have all the data available. And one more thing, if you compile it quarterly, 90% correlation, we found 90% correlation with the GDP on this. And it has been vetted by economists and policymakers as well. So you can go ahead and check the technical note also if you are so interested in this.
Wow. Fantastic. Compliments, Ishan, to you for putting this together, because this is going to be a very, very handy tool to get some sort of an advance estimate of how the economy is shaping up month on month because the GDP data ends up being backdated. We have to wait a long time for the final data numbers to come out. So this is going to be a very, very good and helpful early indicator. Compliments to you for putting this together. And remember, viewers, that this is live starting today. So go out there on Money Control, get all the data points you need to really understand how the Indian macro picture is shaping up. Ishan, thank you for that. And I'm going to go right after the show and check out all the indicators there. Thank you.
Thank you.
Thank you very much.
Thank you.
Okay, well, thank you. Thank you so much. Well, with that, it's time to, like I said, our final conversation on the show is going to be on indirect taxes. You just heard everything about direct taxation. In a bit, we'll have two experts joining in to talk about indirect taxes. We've already seen a major overhaul of GST. Is there anything else that the government should perhaps put on the agenda as well? That's what we will discuss. But before we get to our next set of experts, do check out some of the important earnings of the day. It's a very earnings-heavy calendar. Check out these names and we'll be right back with our experts. Okay, well, those are some of the earnings to watch today. But now, as promised, let's get to that conversation on indirect taxation. Gautam Khattar of Pricewaterhouse is with us. We also have Mr. M.S. Mani, partner at Deloitte India. Gentlemen, good morning and thank you so much for joining in. We just had a whole discussion on direct taxes to understand if we should even expect anything because we've got this big income tax bonanza. And that's really the question on indirect taxes as well, right? Considering that this mother of all GST reforms was announced in September. Should one be expecting anything? And if yes, then what on the indirect tax front? Thank you for joining us. Mr. Mani, let me open with you.
So, good morning, Surabhi. I mean, great to be on your show. From indirect tax point, I think over a period of time, over the last 7-8 years after GST was rolled out, we have seen a very diminished role for indirect taxes in the budget compared to earlier, where we used to have some excise duty changes, service tax changes, etc. So the changes in indirect taxes which come out of the budget are largely limited to customs. However, and this is very important, GST reform always finds a mention in terms of the direction that it is going to take in the coming year as part of the finance minister's speech. If you look at the speech that the finance minister has delivered over the past few years, every year in the budget, whatever she has been saying in respect of which way is GST headed, it gives a directional clarity on what we should expect in the coming GST Council meetings. So while, as you mentioned, the mother of all reforms of GST is done, I believe what we should now be expecting is the father of GST reform, which essentially is GST 3.0. And that, to a very large extent, will involve a lot of reform around petroleum products inclusion in GST, because bear in mind, that's a very big sector that is kept outside the purview of GST. So some directional clarity in terms of what is the government thought process on when they would like to get in petroleum products. Would it be in a phased manner? Would it be over a period of time? Directionally, if we could get an announcement, that would be great. On customs, we have not seen significant rationalization or reform for many years now. We have seen some changes in the customs duty rates. We have seen the processes being tweaked and being made, better. But this is clearly a time for, I would say, a large scale customs reform where maybe we have fewer slabs, easier process of import and export, cutting down on the duration of imports and exports. There is a lot that can be done in customs, all of which will add up to ease of doing business in India. We need to really look at customs as a way of improving our rankings in terms of the ease of doing business in India.
Okay. All right. So those are two important points made by Mr. Money, that after, the mother of all reforms, you need the father of all GST reforms. Look at bringing petroleum products into the GST ambit. And the point on customs. I'm going to come back to the point on customs in just a bit. Let's take opening thoughts with Gautam Khattar as well. Gautam, thank you so much for joining in the conversation. So Mr. Money has laid out two important pillars. Do you agree that these are the two important ones? Is there anything else that you would like the finance minister to take a look at?
So definitely customs is going to be the key during the budget session this year. The expectation is that we continue with the customs reforms along building a trust-based ecosystem, looking at ease of business, ease of doing business, and third is strengthening the Make in India journey, which we have started out. So within these, there are expectations around tariff rationalization. We saw GST 2.0, similar to GST 2.0 under customs. Today, we have 8 slabs. So the expectation is that these 8 slabs should come down to 5 or 6. That is something which we are looking at, tariff rationalization. And also one of the journeys is around inverted duty structure. So that we have, we've done a lot, the government has done a lot, but given the FTAs which the government has signed, we need to look at the inverted duty structures vis-a-vis the FTAs, and therefore look at critical minerals and other products given the entire geo-economic situation, and see how those exemptions can continue, because the journey the government has embarked upon is that the exemptions are being waived off. Now, there are sunset clauses to a host of exemptions as of March of 26. So those exemptions would need to be revisited. So tariff rationalization is one of the key buckets which the government may have to look at. Just one more point around this is certainty. So a long ask from the industry has been around customs amnesty, which is partial waiver of customs duty and complete waiver from interest and penalty. We have seen amnesty schemes announced under income tax, under erstwhile service tax. So customs has been a long ask, and we hope there is movement around this during this budget.
Okay, so that's interesting. Maybe an amnesty scheme of sorts to close out current disputes that could be considered. On the rationalization itself, customs rationalization, gentlemen, I want to understand, what is it that needs to be addressed? I mean, are there some important product lines or categories that come to mind? Because this is all happening at a time when we've just signed this huge FTA with the EU. And I mean, FTAs or some sort of trade agreements seem to be the way to go forward as well, even as we wait for our agreement with the US. So in this environment, what sort of a customs rationalization is needed? If I could get quick takes from both of you. Mr. Money?
So to a very large extent, the 8 slabs that we have in customs make customs very complicated, because we have to bear in mind that with the countries with whom we have signed FTAs and with other countries as well, customs is actually the window that the world looks at to India, both from an export and import perspective. Because when we import goods, the customs duty that are levied, there is certain amount of uncertainty in terms of would it be at this slab, would it be in this slab. Now, we have to bear in mind that 8 slabs is something which is very, very difficult for importers in India to comprehend and for exporters from other country to comprehend. So if we are able to bring them down to 4 or 5 slabs, that will give a very good indication of India's willingness to reform its trade practices. Because bear in mind, customs is one area on which serious reform has not happened over many years now. Every year we have had some form of, tinkering or the other to simplify, things. But that is an area where we now need serious reform to happen. I believe a while back, a month or so back, the Honorable Finance Minister also made a mention that the next area of focus for the government was customs reform. And therefore, it is expected that we should be seeing quite a few customs related announcements in the budget.
Okay. All right. Gautam, weigh in on this as well. You said that 8 slabs should be reduced to say 5, 6. I mean, can you just dive a little deeper into the details of the kind of pruning that perhaps is in order?
Yeah. So, I'll just probably illustrate this with few sectors. So if you look at the sectors today, EV, and in particular EV batteries is within the EV sector. Then there is semiconductors, and then there is also critical minerals, given that what we've seen around the geopolitical scenario. So what we expect and hope is that there should be sector-wise rate rationalization. With what I mean is, in some of these sectors, looking at raw materials. So to the extent there are, and that goes with the thought process of Make in India, getting raw materials at a certain exempted or at a reduced rate of customs duty to enable more Make in India and more manufacturing boost for Indian industry. So I think that is one area from a sector-wise rationalization is very important to be looked at, and we expect that should be done. Second, which I already alluded to, was around free trade agreements. So given the number of free trade agreements which we have signed, a lot of finished products are coming in at a reduced rate of customs duty. So with the journey which we have embarked on Make in India, looking at, again, raw materials, those would be electronic components and maybe other sectors components, to continue with exempting those or getting them at a reduced rate. So I think that would be critical to be looked at when I talk about rate rationalization.
Okay. I'm surprised that you gentlemen haven't brought up gold or silver, because that's where there's been so much chatter, right, with prices surging through the roof. And I mean, India reduced its, customs import duty on gold, I think it was a couple of years back, right? So, I mean, price action will do what it does. Silver can go up 160% in a year, but from a duty perspective, is there any kind of change warranted? And if you could just revisit the current duty levels for us, for the benefit of our viewers as well, Mr. Mani?
So look, when it comes to gold and silver, I mean, they are completely different. So I'll take them differently. As far as gold is concerned, it is to a very large extent price inelastic. And therefore, a customs duty reduction does not translate into more consumption. A customs duty increase does not necessarily translate to reduced consumption. Because of the gold price increase that we have seen in recent times, what has happened is that a lot of old gold is getting recycled within the country. And therefore, to that extent, the gold imports have already started reducing. So even if the customs duty rates were to be lowered for gold, typically, would it lead to increased import of gold? Possibly no, with the current level of prices. When it comes to silver, it is a little different, because silver is one product which is more for industrial consumption and possibly a significant part also for retail consumption. So when we look at both of them, together, we realize that silver to some extent is required by certain industries. It is required at certain industries as a raw material, and it's a very critical raw material. To that extent, the silver imports cannot go down irrespective of the price. And therefore, when silver is imported for industrial purposes, there may be a need to give relief to those sectors only. But when silver is imported for non-industrial use or retail use or domestic consumption, there may not be a need to tinker, with the duty rates over there. Because overall, if you look at gold and silver, the metals market has been functioning in a certain way over the past few years. Most of the metals have been doing, exceedingly, well. And in addition to gold and silver, possibly industrial metals, which are used in conjunction with silver, we may need to relook at the duty rates on those also, because it's a raw material to many businesses. And there is no point in increasing the cost of those raw materials, because many of these, again, are exported from India. So there's no point in building in.
Mr. Mani? So
Copper,
yeah,
bronze.
so I mean, which would be some of these? Okay, and duty reduction to what extent? I mean, where are the
So
roughly where
duty
would the duties
reduction.
be now, and what kind of reduction?
So if the duty rate now is 12.5% on some of these, if these come down to 7.5, to a large extent, it will give the user industries and the exporters in India who use this as a raw material to become more price competitive. We also have to bear in mind that
Of
most
course,
of
yeah,
the
yeah.
FTAs that we have entered into over the past, year or so, which has a lot of FTAs that we have entered into, there is a need to make customs adjustments for sectors which are impacted by those FTAs, because similar products exported from non-FTA countries, if there is a enormous amount of divergence, what that will lead to is that the goods will get diverted to an FTA country and will get imported from that country, possibly without being fulfilling the requirements of the rules of origin. So that is the reason why customs reform, to my mind, has
Okay,
got
fair,
a
fair.
lot of dimensions to it, which needs to be looked at as part of the budget.
Okay, absolutely strong points and all well taken. Gautam, final word with you. And again, on silver, the point that Mr. Money made was very interesting, that maybe you need to have different rates of duties for depending on the use of that metal. But I don't know, I mean, physically on ground, if that is easy to do or not. I mean, silver for industrial use versus silver for retail use versus silver, which perhaps the ETFs and there's a lot of investment demand as well. So, which some of these funds need to hold to fulfill their, investment obligations. So, is there a case for differentiated duty? Does that even work? And just revise for us where the current duty on silver would be, and what could be perhaps a workable solution.
So, first is typically gold and silver. If you look at even the free trade agreements, it's been kept outside. So they're not getting concessions under the trade agreements, primarily to avoid trade diversion, etc. So that's one part. Second, coming to your question of having differential duties on some of these elements based on end use, that is going to be difficult. We also would not propagate that because we've seen the number of disputes it results in. A typical end use benefit, and then the thought process over the years have been that the government is moving away from some of these exemptions which are end use because it is very difficult to monitor on ground. We may have today certain very specific end use exemptions in the electronic sector, which would say X part going in manufacture of mobile phones, etc. But those are specific to develop that ecosystem. But generally, an end use exemption is something which is not sought after. So I believe having these differential duties based on end use may not be viable in terms of implementing at the ground level. And as I said, the FTAs have typically kept these, at least the finished products, which is gold, jewelry, out at this point in time.
Okay, all right. All important thoughts, important points, and let's see how the finance minister navigates some of these issues. Gentlemen, very, very helpful conversation. Gave us a lot of context, and at least it sets us up to understand what the ask is. Let's see if we get that much needed and much awaited customs reform, as both of you gentlemen have pointed out. Thank you for joining us. Have a fantastic day ahead, and we look forward to connecting again once the budget announcements are out of the way to make sense of whatever is finally announced. Thank you for being with us on Money Control.
Thank you very much.
Thanks. Okay, all right, viewers, it's time to start winding things down. We are in the last leg of opening bell. And the news from the market is that the market continues to dip, continues to be under a little bit of pressure. Nifty is down about 0.6% right now. Screen is suddenly red. We had 2 green days. This morning, Thursday morning, it's again a red looking screen. The Nifty is actually falling more than the other indices. There you go. It's at the day's low right now. The mid-cap index is down about 0.25%. The bank Nifty is down about 0.2%. So it's really a large cap heavy fall, so to speak. Let me quickly pull up some of the other indices just to get a texture of the market and see, how things are shaping up. On the metal side, there's still plenty of buying. And if you see the Nifty Metals Index, for instance, that's the only one in positive territory. Nifty Metals Index up about 1.7%. But other than the metal side of the market, there aren't too many gainers to really speak of. That's one. Look at the oil and gas index. The oil and gas index is managing gains. It's about 0.5% up. So it's really these hard commodities, metals, energy, oil and gas. This is the only green zone of the market this Thursday morning, at least at this juncture. On the flip side, IT is weak, auto is weak, consumption is weak, Nifty FMCG is weak. Those are the weak sectors. Okay, those are some of the gainers on your screen as well, and many of those stocks come in from the metals pack as well. And those are the losers, as you can see. Auto stocks, again, really reeling under pressure. M&M Maruti. So that profit booking is still very much underway. Okay, let me quickly check the mid-cap market to see what is happening out here. Some individual stock action. Let's pull up the individual stocks. Oil India. Even yesterday, names like ONGC and Oil India rallied in a big way because crude oil prices had surged. And remember, crude oil prices have moved up at least 4-5% in just the last 2-3 days. Brent oil is now touching $68 a barrel. And the spiral in oil prices is obviously, it's a macro concern. But more importantly, it's leading to these interesting trading moves. So Oil India should be on your screen. That stock is up about 5% at this juncture. Okay, one more stock we should pull up is United Spirits. I'm just getting it up on my screen here. Let's see what USL is doing. United Spirits at this point is up 0.5%. That's Oil India. Let's pull up United Spirits. And I'll tell you why I'm talking about United Spirits in just a second. Yeah, the stock's up about 0.5%. Now let's see what is the story. And for that, we have to get to our special segment, MC Hot List. And the story we are featuring on the MC Hot List today is all about what happens to Royal Challengers Bengaluru. United Spirits wants to sell off the franchise. Who could the new buyers be? What's happening behind the scenes? Well, the man who's tracking that action, Ashwin Mohan, is with us on the show now. Ashwin, good morning and great to connect with you.
Good morning, Surabhi. So, this is clearly a trophy asset. Keep in mind that there are several other teams where stake sales are also going on as far as the IPL is concerned. It's not just RCB. There's also a deal going on at Kolkata Knight Riders. There's also a deal going on at Rajasthan Royals. But this is indeed the big one, because this one is going to set the benchmark as far as valuations in this space are concerned. You were speaking a short while back about the USL stock. Don't forget that the Diageo stock, by the way, Surabhi, has also perked up. In fact, it's gone up by more than 14% in the last 5 trading sessions overseas. So clearly there's a lot of anticipation around the monetization of this non-core asset. Remember, at the end of the day, Diageo is a liquor company and an IPL franchise is non-core to them. Now, the exclusive details that we broke on Money Control last night is that as far as the ongoing process is concerned, which is being conducted by investment bank Citi, what we are given to understand from our sources is that United Spirits has sought the early or non-binding bids or offers for RCB by February. So the first week of February, that's when they're expecting the initial bids to come in. There's been a frenzy of interest, whether it's strategics, whether it's private equity funds, whether it's sovereign wealth funds, whether it's NRIs, entrepreneurs. So a whole host of people, Surabhi, have in fact signed as many as 50 plus NDAs on non-disclosure agreements. So that tells you about the excitement around this asset. But keep in mind that many of these entities are likely to join hands and later form consortiums. So that's something that one needs to keep in mind. Talking about consortiums, what we are also exclusively picking up from our sources is that Manipal Group's Dr. Ranjan Pai is in fact in advanced talks to form a combine with private equity giant KKR. We are given to understand that Singapore investment giant Temasek, that's also a party that could potentially be the third investor in this consortium. And of course, Adar Poonawalla of Serum Institute has stated his intent publicly as far as the interest is concerned. Many are saying that there could be finally a fight between Adar Poonawalla's consortium, which is being backed by TPG, we understand, and Ranjan Pai's consortium. But let's not forget, these are still early days. And we also need to keep in mind about the valuation, Surabhi. One last point, the valuation being sought was around $2 billion. What we now understand is that the deal may settle between $1.5 billion to $1.7 billion. So all eyes now on who submits those early bids in the first week of February. So it'll be back to you.
Okay, Ashwin, so from what you describe, it's a league of its own. It seems like the clash of the titans, maybe as you're saying, Mr. Adar Poonawalla, KKR, different consortiums coming together and battling it out for that trophy asset. Very, very interesting story, Ashwin. Thank you so much for, getting us all the details and for keeping us on top of it. Good to have you on the show this morning, and we'll connect again soon. Thank you.
Bye.
Okay. All right. With that, viewers, it is time to wind down today's edition of Opening Bell. We're leaving the markets a little tentative, about 0.5% lower on the Nifty. Let's see if there's a recovery through the course of the day. But for now, many thanks for watching. We'll be back with a lot more around the closing hour.